Welcome to More Than Money with your host, Ross Marais. This episode of More Than Money is brought to you by More Time Financial, a financial planning company who are on a mission to help young Australians make smarter decisions with money by providing real-life financial advice, coaching, and financial education.
Hey, what's up? It's Ross Marais. Welcome back to another episode of More Than Money. On this podcast, I have real conversations about lifestyle, money, and business. Sometimes I share interviews with business owners and entrepreneurs about starting their own business and their journey. Other times we do financial education and informational episodes to help you make smarter decisions with money, just like this one. So if you're new here, consider subscribing. Now, before we get started on today's episode, this is just a friendly reminder in order to keep our lawyers happy that in preparing this podcast, myself and any contributors have not taken into account any particular person's objectives, financial situation, or needs. So before acting on any of this information, you should consider its relevance to your personal circumstances, and if required, seek the assistance of a licensed professional. In this episode, we're going to talk about your wealth growth plan. So just a quick recap on what we've covered over the past 8 episodes. So first of all, we looked at how do we actually build your wealth. So that's getting financially organized, getting your shit together basically, increasing your savings, and reducing any debts that you might have. Then we moved on to step 2, which is all about protecting your wealth. So that was building up your emergency savings fund, having in place the right insurances, and also putting in place appropriate estate planning documents to protect you and your family. Now, over the next couple of episodes, we're going to be talking about how to actually grow your wealth. So today is the basics of investing. So we're going to cover everything you need to know about how to get started on your investment journey. We'll explain the different types of investments available, such as stocks, bonds, investment properties. And we're also going to discuss the importance of setting financial goals and having a clear time frame before you actually start investing. So by the end of this episode, you'll have a solid foundation in the basics of investing, and you'll be well on your way to building your wealth for the future. Hope you enjoy.
So while we know that investing is important and that we should be investing, most of us don't know what investments are. We find them very confusing, and therefore we tend to avoid them as much as possible. When we think about investing, you might hear phrases like, he invested in, or I'm going to start investing in, or he invests in this type of thing. The definition that we like to use of investing is the use of money for something, we're not sure what that is, in order to earn more money. So it's using money or capital for something in order to earn more money from that. And a phrase that you may use to explain this further is he made his fortune by investing in real estate, or they made their fortune by investing in stocks and shares. Before we talk about investing and what to invest in, it's important to understand the types of investments that you can potentially hold. Now, in this case, we're assuming that we're holding financial investments. So the 4 main areas, now there is obviously a lot more as it gets a lot more complicated, but to keep it simple, the 4 main areas of financial investments are the following. We have cash, which is either savings or term deposits. We have fixed interest, or what is called bonds, which we'll explain in a bit more detail. Then there's property, split into residential and commercial. And finally, we have shares, which could be Australian shares or international shares. Now, there's obviously a lot more sectors and different types of investments that we could potentially make, and alternative investments and things like that. But as I mentioned, in order to keep it simple, we have our 4 main areas. So we have cash, savings, term deposits, which you should hopefully understand to a point that if you hold money in a term deposit, you're likely to receive some additional interest. Fixed interest, or bonds in this case, is similar to a loan. So you'd take out loan from a bank. In this case, you're giving money, you're investing into a company or a corporate bond or a government bond. In exchange, they pay you some interest for lending them the money. Residential and commercial property, assuming most people listening to this would have had some experience with the property market, either as a renter or an owner. And then shares, as I mentioned, we have Australian and international shares. This could be something like BHP, Commonwealth Bank, Woolworths, or international shares like Facebook, Google, or Amazon. But anytime we think about investment types, we break them into 2 main categories. So those 2 categories are defensive investments or defensive assets. And the main primary purpose of this is to gain some sort of income. So the value of the investment isn't expected to change materially, such as cash or term deposit, but we would receive some form of income or interest from that investment. So using the term deposit example is an easy one to understand, where you put your money into term deposit, you're going to get that money back plus some form of interest or income from that investment. Alternatively, we think about growth investments or growth assets, and the main purpose of this, hence the name, is to grow the money. So we are hoping that we put some money into an investment and it grows above the amount of money that we put into that initial investment. So defensive assets we think about is cash and term deposits or fixed interest, and growth assets or growth investments we think about Australian shares, international shares, property, etc. So you may be thinking, well, that's great. I understand the types of investments, but I've never really understood how investments work and why people always tell me that I should be investing. That's what we're going to discuss here. So if we use the example of an investment property, hopefully most people listening to this, as I've mentioned, should have some experience with a property, being a renter or a potential owner. In Australia, investment properties or property is one of the most popular ways for investors to earn additional income. In this example, we're assuming that you as the investor purchase a residential property to rent out, and you're renting out just to normal tenants and they pay you a monthly or weekly income. If we purchase a property of $500,000, the first type of investment return we're going to see on that money is a rental income or a rental return. So in this example, we're assuming that we get $500 a week in income. Yearly, that's $26,000 per year, roughly 5% per annum. Now, these are very round, simplistic figures, and I'm not expecting you to find investments that give you these forms of return. But it's important to understand that the first type of return we get on our investment is a rental income. Secondly, we have what is called capital growth or investment growth. If we fast forward 10 years, our value of our property is now worth $740,000. So we've experienced some growth or capital growth of $240,000, approximately 4.8% per annum. We can see here that we're getting two types of return on our investment. We're getting our income return and we're also getting our growth return. So that's important to consider anytime that we're looking at investing. So that is investment properties. Secondly, we've got shares, which can be a little bit more confusing, which is why people tend to gravitate more towards property because it's a little bit easier to understand. Buying shares, also known as stocks, securities, or equities. So if you hear on the news when they talk about the stock market or securities did this or the equity market did this, they're talking about shares. So buying shares, stocks, securities, or equities, makes you a part owner of that company. As a shareholder or part owner, you get dividends or other benefits from owning shares in that company. Now, again, if we look at this example, we purchase shares of $50,000 into a publicly traded company. Now, it's important to understand that there's two types of companies. One is a publicly traded company, and that is a company that is on the stock market, which is available for the public to invest in. Secondly, we have private companies. So a private company would be a company that you would potentially start if you were starting your own business. It's a privately held company that the public can't just openly invest in. For this example, we're assuming we buy $50,000 in a publicly traded company. Choose your favorite type of company, and let's use that example. Looking at the property example and applying the same principles here, we can potentially get an income return and a growth return from our shares, much like we did from our investment property. We're assuming here that we get $500 per quarter. So every 3 months, we receive $500, which is $2,000 a year, in the form of what is called a dividend. So a dividend is the rent equivalent of an investment property. By owning shares, some companies provide their shareholders with dividends throughout the year. Some pay monthly, some pay quarterly, some pay yearly. So for this example, we're assuming that we get an income or a dividend return of $500 per quarter. Secondly, much like the investment property, we have the potential, but not guaranteed, the potential for capital growth. If we fast forward 10 years' time, our value of the shares has now increased to $80,000. So we have experienced a capital growth of $30,000, which in this example works out to be approximately 6% per annum, roughly rounded. So that is the example of investment property and shares. Now, obviously, you spend a lot more time on this, but if you have any questions, please make sure you write them down and we can discuss them further. So now that we understand how investments work, you might be wondering, well, that's all well and good, but why should I invest? Why do people keep telling me to invest? What is so great about investing? This is a quote from Warren Buffett, who is the most famous investor. And his quote reads as follows: if you don't find a way to make money while you sleep, you'll work until you die. So if the only way that you make money is from working a 9-to-5 job and going to work 8 hours a day, then unless we're investing and growing our money somehow, we will continue to work for that money until you die. By investing, you have the opportunity to earn what we call passive income. So passive income is making money from your investments that you don't need to work for. And when I think work, I'm meaning sitting at a computer or working as a tradesman for 8-10 hours a day. So if you don't need to work for your money, you have the potential to earn passive income. So that's why it's very important that we start investing regularly and we start investing as early as possible. One of the biggest misconceptions that I find is that when people talk about investing, when I say, well, are you invested in anything? Like, no, I've got savings, I'm saving, I'm investing. And that term gets thrown around interchangeably. And while savings is a prerequisite to investing, meaning that you just can't just start investing if you don't have savings. So unless you've inherited or won or borrowed the money somehow, for most of us, we're going to save and then being able to start investing. However, savings and investing isn't the same thing. So it's important to understand the difference. Shown here is the difference of investing versus saving $10,000 over a 10-year period. If we put money into a savings account and earn 2%, we have the potential return or the potential increase of $2,200, meaning in 10 years' time, the value of that $10,000 could potentially be worth $12,200 if we put it into a savings account and withdraw it in 10 years' time. Conversely, if we think about investing that money and potentially earning a return on our investments of 5, 7, or 9%, we can see what that does to our end value in 10 years' time. The key thing to remember here, which we'll explain, is that the level of risk. So the key difference between here is that if we put our money into our savings account and earns 2%, we know that there's a very high likelihood of our money being there when we need it. Conversely, we have the potential to earn a higher return on our money by investing that money, but it's not guaranteed that we're going to receive that type of return year on year, or potentially that investment could go down. So it's just important to understand that when you think about investing and saving, they are not the same thing. The next thing we need to consider when we talk about investing are your investment goals and your investment timeframes. Everyone has different goals, everyone has different timeframes, so it's important to understand those things before we start talking about investing, because they are going to form the basis for how you invest, where you invest, and how much you invest. When we think about investment goals, the couple of things that we work with our clients on are children's education funds, so saving money for children's education, potentially buying an investment property. So we think about investment properties, kids Kickstarter funds, so that might be putting money away for when your children turns 18 or 21 or 30, so helping out with the first car or first home. A business startup fund, an early retirement, or what we call a financial freedom fund, and then your traditional retirement fund. So something that you'd have when you turn 65, for example. Those are the different types of investment goals. Then we think about investment timeframes. It's critical that we know what the intended timeframe is. This doesn't need to be locked in concrete, but the intended timeframe for each of the investments you make, because the difference between a potential investment that is of a 12-month timeframe versus an investment that is of a 30-year timeframe is going to make the world of difference. If we think about a short-term goal of having a family holiday and spending $7,000 every 12 months, it's going to be unlikely that we're going to invest that $7,000 or the savings for that $7,000 into a high-risk investment, because we need to have that money in 12 months' time to reach our goal. Conversely, if we think about a long-term retirement goal of having $1 million in retirement savings in 30 years' time, that is drastically different in the form of time frame. So it's important to know what our timeframes are within reason, and then that will allow us to invest appropriately. That then moves us on to investment risk. Investment risk can be defined as the probability of experiencing lower returns or even losses relative to the expected return. So that is the risk that you take when you invest. Now, there's no such thing as a risk-free investment, and anyone that tells you otherwise is likely lying to you. When we think about investing and risk, the key thing to note here is the risk versus return. This can be slightly complicated, but we have a potential return. So we can see that we've got a lower and a higher potential return. And it's important to understand that this is potential. And then we have the expected risk. So we have lower expected risk versus higher expected risk. We can see that the different asset classes or investment types go from lower risk to higher risk, but also the potential return increases. Using the example of cash, so if we put our money in cash, we know that there's a very high likelihood that that money is going to be there when we need it. It's not going to go up and down in value considerably or potentially at all. So the risk that we can expect is very low, but the potential return is low as well. If we think about shares and potentially alternative investments, which we won't get into today, but if we think about shares, we have the potential higher return, but we also have the higher expected risk. So it's important to understand that if we are going to be investing in properties and shares, yes, they have the potential to give us a higher return, but they also have to give us potential for a higher risk investment. So this is where it becomes important to understand what is your appetite for risk, also known as your risk profile. So your risk profile is your willingness to and ability to accept investment risk in order to achieve your returns. You might have a lower tolerance or a lower likelihood to be investing aggressively or invest in things that you're uncomfortable with because of the level of risk. So it's important to understand what your level of risk is before you start investing. This is an example of using what we showed you earlier, defensive versus growth assets. So we have here varying types of risk profiles, moving from being a secure risk profile up to a high growth risk profile. An example of a secure risk profile, you would hold 100% of your money in defensive assets. So that could be the cash, term deposits, or fixed interest investments, and holding zero growth assets. Now that may be fine, but it's important to understand what that means for your potential return. So if we're going to be taking a lower risk investment, we have the lower likelihood of return. Conversely, if we think about a higher growth investment, we have zero defensive assets. So that would be zero money sitting in cash and term deposits, and all of that money sitting in growth assets, which could potentially be property or shares. And then we've got everywhere in between.
So that wraps up the basics of what you need to know when it comes to investing. So just a quick recap on what we've covered in this episode. So first of all, the importance of understanding the different types of investments available. So we have cash, fixed interest, properties, and shares. And as I've mentioned, there's a number of different subclasses of investments that go underneath each of those broad categories. How investments actually work, so understanding the key difference between income returns and capital growth. And ideally, anytime you are choosing an investment, you want to be clear on what is the purpose of this investment. Are we investing for income? Are we investing for capital growth? Or are we hoping to get a combination of both? The key difference between savings and investing, so it's important to understand your different investment goals and timeframes and how each of those savings goals and investment goals tie into each of them, because we know that those terms get used too interchangeably for my liking, and it's just important that we clearly separate the difference of this is my savings goal, this is my investment goal. And then finally, we wrapped up talking about the key investment risks that you need to be aware of. So there's no such thing as a risk-free investment. Even putting money in the bank has some sort of risk attached to it. So before you make any investment decisions whatsoever, it's important to understand what those risks are, making sure you're comfortable with them before you make any further decisions. So if you have any questions at all regarding any of the information we covered in today's episode, be sure to follow the links in the description below to submit your question, and I'll do my best to answer them on a future episode. So over the next few episodes, we're going to be doing a deep dive into all things investment properties and superannuation. So stay tuned for those future episodes. Have a great week.
If you've enjoyed this episode of More Than Money, make sure that you subscribe to keep up to date with all of the latest episodes. And feel free to like, comment, and share with a friend.